heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, this is Bloomberg Technology. Coming up, Intel secures an $8 billion grant for its U.S. chip factory expansion after months of trying to convince Washington and Wall Street that it can execute on its vision. Plus, California, it proposes state incentives for EV buyers, which could exclude Tesla's models. And social media companies push back against new legislation in Australia that's going through the courts that could limit teen usage. But first, let's check in on these markets, because we're currently higher to the tune of 0.4%. We're managing to shrug off some of that anxiety once again being built in around geopolitics and amid tariffs that we're going to break it down for you a little bit later. But still, big tech managing to lead us higher. And in fact, the S&P 500 on track for yet another set of records. And the Nasdaq is up for 4 straight days. Move on and look at some of the individual movers, because we have still got some drip feed around earnings that have come after the bell. I want to look at what's, of course, been happening in the world of Zoom and another key chip maker. Zoom down some 7.9%, didn't live up to expectations in terms of its growth for its fiscal third quarter. And I think most notably is because this stock has run up hard since its bottoming out in August, some 60% higher. Many analysts saying, look, it showed solid numbers, but not as good as the market had been pricing in. Analog devices, down a percentage point, had been rallying earlier in the trade after they showed some strength in terms of auto sales and chips, but now just taking a turn into the red. But let's stick with chips now, because Intel securing $7.9 billion in federal grants from the Biden administration. The deal is actually marking the largest ever direct subsidy from a program. And this is, of course, to boost U.S. chip production. Sources telling Bloomberg Intel will get the money for projects in Arizona, in Oregon, in New Mexico. Bloomberg's Mackenzie Hawkins joins us now. And Mackenzie, Ohio not on tap for this particular area of money because it's not far down the road enough in terms of, well, digging in and breaking ground. Where do we stand in terms of actually building?
So Intel's $7.9 billion award from the CHIPS Act supports projects across 4 U.S. states through between now and 2030, by which time Intel plans to spend $90 billion of a total $100 billion capex on U.S. projects. But projects have to meet certain benchmarks and milestones to qualify for a funding disbursement. So it'll take a while for the money to actually go out the door and make it into Intel's hands. The first roughly $1 billion of that will happen this year because Intel has already made progress on projects in Arizona, New Mexico, and Oregon. Ohio, construction was supposed to finish by late 2026. Now, one of the facilities won't be online until the next decade.
Pat Gelsinger has joined Bloomberg Technology and sort of vented some frustration at how slow it's been to get the money from the U.S. government. And also, you note that this is a little bit less than previously estimated.
So it's been a very long process for Intel and for all of the other companies. Intel's award was announced at a preliminary stage in March for $8.5 billion. And since then, the company's been going through due diligence. There have been disagreements about how much information Intel has to disclose to the government, and also about terms specifying what happens if Intel spins off its manufacturing business or is acquired in part or in whole. That's obviously a pretty tense discussion with Intel when they're going through some serious financial problems, and there have been conversations with other players in industry about potential M&A. The haircut that Intel took on its award is actually not because of those business problems. It's because the company is separately getting $3 billion to make chips for the Pentagon. That program was originally supposed to be mostly funded by the Defense Department, but after a big funding spat involving various departments in the Biden administration and lawmakers on Capitol Hill, the Commerce Department had to use its own CHIPS Act money to support that program, and some of that came from the money already set aside for Intel.
Breaking down the numbers and some of the M&A rumors, Mackenzie Hawkins, really appreciate it. Thank you. Look, sticking with those M&A reports previously, Qualcomm's takeover interest in the company is actually cooling. Now, sources are telling Bloomberg the complexities associated with acquiring Intel have made it less attractive to Qualcomm. A deal would likely have been one of the largest ever in technology. Meanwhile, more on chips and tech more broadly. Let's bring in Nancy Curtin, Chief Investment Officer of LT Tiedemann Global. Nancy, it's always so important to have your voice on the show, talking about the global context here. Just dig in on, for example, M&A, hopes around this new administration coming in 2025, and deals getting done, chips being supported or not supported as a sector. What do you make of it?
Well, let's start with M&A first, and we do think that M&A will increase. You have pretty rigorous merger guidelines passed by President Biden in 2023. We reckon those will be undone under President-elect Trump. And remember, they had lowered the guidance threshold at a company being seen as anti-competitive. So we do think it's going to be a friendlier environment for regulation, a friendlier environment for M&A, and expect that animal spirits, M&A, and IPOs will pick up in 2025. So we think this is one of the positives coming from Trump. Just quickly on the CHIPS Act and Intel, are we back in the wrong horse there? This is supposed to create jobs. They just laid off 15% of the workforce. And I kind of look at it and think NVIDIA didn't get any money from the CHIPS Act. And it's actually doing a pretty darn good job of actually supplying the chips industry. So I think this is a program. It's hard to change and remove these legislative programs. It's not a program that President-elect Trump favors very much. I think he called it a really bad program.
Yeah.
So stay tuned.
On NVIDIA, though, they basically get TSMC and other chip makers to produce. This is all about onshoring and making sure that chips can be made in the United States. When you're looking at NVIDIA and indeed its exposure, whether it be selling into China or indeed depending on a supply chain that is in many ways related to Taiwan, how does that factor into an investment thesis?
Well, as you know, Trump has said tariffs the most beautiful word in the English language. So, maybe Trump just used some tariffs here on TSMC because that would encourage them to think about, and by the way, they were part of the CHIPS Act as well. So they did receive some subsidies there. But, that might encourage them to accelerate production in the United States. Now, how will NVIDIA respond? I don't know. With 74% gross margins, and it seems like insane demand, in Jensen Huang's words, it seems like they're just going to raise prices. So, if we get some tariffs on TSMC, which I wouldn't be surprised, I just think NVIDIA will end up passing that on to its demand-hungry customers.
It feels like you've got some nuance about which horses you should back, but more broadly, the winners are likely to continue winning into the next administration. Is that what you're articulating? Is it still good to be long big tech here?
Let's just talk about a little bit of the winners in semiconductor. At the end of the day, NVIDIA is clearly in pole position, monopoly position. More demand than supply. But competition is coming. Remember, 40% of their data center customers are also trying to compete with them. Amazon's coming pretty close here in developing a chip. Now, I understand it's 40% cheaper. Not really sure the performance benchmarks with respect to training and inference. They haven't been published, and it's not clear it's in production mode, so to speak. So let's see what happens. And of course, to a certain extent, AMD and Intel are fast trying to be competitors as well. So competition is on the way, and we should expect to see more of that. People are looking at the price of NVIDIA chips, the fact that they can't get access and are trying to diversify their supply sources. And that makes sense, right? So we do expect competition to come as we look forward. Now, I don't say this is a Q1. I think NVIDIA should have another blockbuster quarter. Certainly, they were pretty clear about it.
Yeah.
They expect revenues to be up 70% in the next quarter, and they normally beat that number. So let's see where that comes out.
Customers look at the price of the chips. Investors look at the price of the stock. With an NVIDIA trading at 46 times future earnings, many have been perhaps taking a bit of profit. When you're looking at Tesla that's trading at 141 times future earnings, what do you make about the optimism baked into that stock post-election?
Well, Tesla is clearly a special child at the moment, given the relationship between Elon Musk, and Trump. And these stocks, these Magnificent Seven, on average, they're at about 35 times forward earnings at the moment. And that makes them very vulnerable to disappointment, right? So one of the themes that we've had on this year is, tech is fine. We believe in Gen AI, but you need to diversify beyond just those Magnificent Seven technology shares that have fueled the market's advance. And we think mid-cap in particular, trading at about 13, 14 times earnings, up close to 10% already this month, is an excellent beneficiary of MAGA, potentially corporate tax rate cuts, manufacturing renaissance, and a better outlook for growth in the United States. So there are other things you can do and diversify away from tech. By the way, where earnings are expected to decelerate in the so-called Magnificent Seven as we head into 2025, where they're supposed to accelerate in the rest of the market. And so I think that's a really nice way to still earn a return, participate, but protect some of that valuation potential downside risk in tech.
Nancy Curtin, always great to catch up. Thank you, Chief Investment Officer here at LT Tiedemann Global. Meanwhile, let's just talk about globally. China's Xiaomi preparing a self-designed mobile processor for its upcoming smartphones. This comes as an effort to actually reduce its reliance on foreign suppliers, Qualcomm, MediaTek. According to sources, mass production of the chip is expected to begin in 2025. Coming up, well, it's deja vu. President-elect Donald Trump rattling markets across the world with more tariff threats. We discuss the potential impact on the tech sector next. And we were just looking at Tesla with Nancy. Let's dwell on it a little bit more. Up a percentage point, we'll recover from some of yesterday's sell-off. We're going to dig in on what California is currently threatening, how they could be excluding them from any future support for EVs if indeed federal support is taken away. This is Bloomberg Technology. President-elect Donald Trump took to Truth Social to vow additional tariffs on Mexico, Canada, and China. And the comment marks his first specific threat to the top trading partners of the United States since his election win just 3 weeks ago now. Bloomberg's Michael Shepard joins us now for more. He promised it on the campaign trail, and now he's once again reconfirming.
He's taking a step closer, Caroline. This is what the president-elect had been telling his voters all along, that he would try to bring manufacturing back to the U.S. using tariffs as his primary weapon. Now he is threatening to use tariffs for something else, and this is to extract policy concessions from America's key trading partners. With Canada and Mexico, it's his concern about the border. And with China, he is really trying to get Beijing to cooperate more, in his view, to stem the flow of fentanyl in the U.S., which has been blamed for a surge in overdose deaths in recent years. So we're seeing tariffs being applied in a different sense, not purely economically, but to actually get a policy goal out of a key U.S. counterpart.
Yeah, and some of those policy goals are ones we heard in the previous administration too. The market more broadly has sort of taken it in its stride. And I'm wondering whether people feel that there'll be carve-outs, whether or not this will specifically hit certain industries, Mike?
Well, there's so many unanswered questions around this, Caroline, right now, because he really just kind of dropped it on Truth Social less than 24 hours ago and walked away. And his transition team has not answered any further questions about, just as you say, will there be carve-outs? Is this in addition to the tariffs he had already been threatening, a 60% level against goods coming in from China? And likewise, what does this mean for the USMCA agreement that he forged to replace NAFTA during his first term in office? In any case, this will have a major ripple effect on the economy and on supply chains if enacted. It would affect autos. It would affect very significantly the tech trade with China. We do a huge amount of business with Chinese companies, sending them legacy semiconductors, getting finished computers back, and all of that would be roiled by this. And we would have to watch for these trading partners to assess, as Mexico warned it might do today, whether they would retaliate in kind.
Michael Shepard, always such a thorough setup. We really appreciate taking us through what is, at the moment, just a statement on Truth Social. But let's try and extrapolate it out with Mary Lovely, Senior Fellow at the Peterson Institute for International Economics. And Mike there was discussing how this will affect autos. Immediately in the tech industry, we think EVs. But Mary, what are the ramifications on the auto sector, do you think?
Yeah, it's great to be with you. Well, first of all, when we're talking trade with Canada and Mexico, the first up has to be the auto sector. It's the most important export other than fuel from Canada that comes from our two USMCA partners. Production is fully integrated between the United States, Canada, and Mexico. Cars go back and forth. By some accounts, certain vehicles can go back and forth across the border 7 or more times before they're sent to an auto dealer. So this would be extremely disruptive. We would imagine that auto companies would be lining up to tell the new administration how harmful this would be, not only to the two countries involved in this, Canada and Mexico, but to the United States and to the plants that are in the United States waiting for those parts. So undoubtedly, it would lead to disruptions of U.S. production.
And increased costs, as many would anticipate from a consumer perspective. What about the supply chain when it affects China and U.S. technology companies here? How intertwined, how dependent does the U.S. remain on Chinese parts and goods?
Yeah, since the first trade war, U.S. Has depended less strongly on China. But we have to remember that many of the electronics devices that we know and love were not actually taxed under the first trade war. So final items like laptops, notebooks, smartwatches, cell phones, none of those were actually hit with the first trade war tariffs. Peripherals were things that we may use with these devices. So that's, he has already proposed or promised a flat 60 on China. We don't know if this extra 10% that he sent out last night is by a social media post is on top of that or part of that. Either way, it's going to be extremely disruptive because our companies have not had time to move these vast supply chains out of China.
Take Apple for a case study. They have been trying to depend more on India, for example, other Southeast Asian countries. And we've seen Tim Cook just in China over the weekend trying to ensure that relationships remain strong with the government there. But also, many understand that Tim Cook has a decent relationship with the incoming administration. Do you think CEOs are anticipating carve-outs? Do you think CEOs are able to manage this without passing it on to a consumer?
I think they understand how disruptive this would be, and that if we know that there are constitutional limits on what the president can do. He's shown a penchant for trying to blow past a lot of the limits that people have tried to place on him. But he can't revoke the law of economics, and there's economics limits to what he can do, or at least economic constraints that are going to cause him a lot of trouble, not only in individual sectors, but on the macro front. Inflation will kick up again, for example, something which voters have shown that they dislike intensely. So I think it would be wise that C-suites are anticipating that this will be either set up with carve-outs or it will be rolled back in terms of the absolute tax amount that he is going to levy. So I think we have a long way to go before this social media quote becomes new taxes on U.S. trade.
How effective in the first iteration were tariffs on changing the flow of goods out of China and the U.S., reducing perhaps dependence or indeed the overall trade excess or lack thereof?
I think we saw the value of trade drop by about 30% between, U.S. and China. Remember, China also retaliated against the U.S. We would certainly expect to see some retaliation again, not just from China, but also from our other partners. So it had a significant effect on trade flows. That said, a lot of that trade was diverted to third countries. There's very little evidence that any of that activity came back to the United States. Some of it flowed to Vietnam, some of it flowed to other parts of East and Southeast Asia, and of course some of it went into Mexico, which is why we've seen our trade, particularly in electronics and electrical devices, increase with Mexico.
Mary Lovely at the Peterson Institute, breaking it all down. We thank you. Meta, TikTok, Google, they're taking aim at Australia's legislation to ban children under 16 from accessing such social media platforms. The government in Australia is pushing to pass the bill through Parliament this week. Under the proposed bill, the social media giants would be responsible for policing that ban under threats of fines of up to $32.5 million. Let's bring in Bloomberg's Kurt Wagner. And look, $32.5 million is but a drop in the ocean for any of these companies. But what is to fear here for them?
Yeah, I think the bigger concern here is that this serves as some kind of a blueprint or template that other countries are going to adopt, right? I mean, the last thing these companies want, these services want, is for teenagers, young people, to not be able to use their services, because that's how they get that next generation of users. And so if this ends up working in Australia, or it ends up getting passed and sort of effectively ending that connection, there would be real concern that other countries, especially those in Europe where regulation around these big tech companies has been much tighter, that other countries would try to maybe follow in their footsteps.
It's interesting that we've had a spate of activity around protecting young people, whether it's in gaming with Roblox, but also Instagram, for example, they have their teen accounts rolled out. What is it then when Instagram parent company Meta is coming out and saying that this is going to be really hard to enforce? We had a statement from Meta saying that the approach will require each app provider to collect personal identification or biometric data from all Australians. Are they trying to make out that this is an issue of free speech and identity here?
Yeah, I mean, this is kind of an old playbook from them, right, which is to really push back and say, hey, this is impossible. Technologically, we can't do this, right? And Meta's not the only company to say those kinds of things. At the same time, those teen accounts you mentioned, Caroline, are exactly the type of thing that you would think they could roll out in Australia, right, which is they automatically put teens into more strict settings. They require, ID or some other type of verification before those teens can age up into an account for 18 plus. And so while I do agree that it probably is a very tough technical challenge, I don't think it's necessarily impossible. And I think it's in Meta's best interest and all these companies' best interest to get across the fact that this is a tough challenge, right? That's their argument, is that, hey, we can't do this.
All eyes on how it goes through the Parliament this week. Kurt Wagner being asked to work hard up until holidays. We thank you. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. A quick check-in on these markets and more specifically crypto, because look, the ecosystem added about $1 trillion since the election of Donald Trump for the administration in 2025. We had seen a bit of a pullback from close to $100,000. We've cooled down slightly, maybe sort of about a 4-day sell-off, 8% wiped off. We're now recovering a little bit, up 0.6%. 94,263 is where we trade as people lock in profits, maybe question some of the geopolitical risks once again and some risk aversion. But more broadly, let's talk about politics post the election of Trump. And in particular, California Governor Gavin Newsom proposing a state incentive for EV buyers. That's if federal support is taken away, but it would exclude Tesla's models from a market share limitation perspective. Look, this move is aiming to create market conditions for more car makers to enter the EV market, but can further escalate tensions between these two characters, Elon Musk and Gavin Newsom. Let's talk about it all with Bloomberg's Ilyahu Kamisha, who joins us for more. And look, this is Gavin Newsom trying to front-run any change from the new administration. If they take away that $7,500 tax credit for EV purchases, California will be there to step in and support. But why limit Teslas?
Yeah, that's exactly right. This is part of Newsom coming out in front and saying if Trump does take this away, Californians are still going to be eligible for electric vehicle tax credits. But the proposal that he gave yesterday says that there's a market share limitation which would prevent Tesla from qualifying from these credits. Their reasoning for that is that they want to spur competition of smaller electric vehicle manufacturers in the state, and they said they want them to take root in the state. So essentially they're saying, Tesla already has a huge market share in the state, and they want some of the smaller guys to be able to compete. A lot of these other electric vehicle manufacturers are losing money. Some of the traditional OEM manufacturers are losing money when they sell an electric vehicle. So this is kind of an incentive for those smaller guys, while Tesla is making money every time they sell a car.
Yeah, I can imagine, though, Eliyahu, that this is going to be seen as, therefore, punishment for success, for punishment for being profitable already. I mean, what do we anticipate in terms of the reaction coming from Elon Musk? Because he's not been afraid to have pretty tough words for Gavin Newsom in the past.
Yeah, I mean, Elon Musk has already come out swinging, and he called this proposal insane, and he cited that Tesla is the only car manufacturer that is actually producing cars in California, and they have a lot of employees based in California, even though they did move their headquarters to Texas. So I think it really does raise the tensions between these two characters. California is becoming this foil to the Trump administration, and Elon Musk has taken a newfound prominence in Republican politics. So you're seeing kind of Elon Musk and Newsom becoming these emerging characters that are representing kind of the new state of politics in the country right now.
California, it's a massive economy. Eliyahu, Commissioner, thank you for breaking it down. Let's just keep this discussion going with Jessica Caldwell, Head of Insights at Edmunds. And your focus that you can bring us is the underlying data of EV sales, the actual success story that Tesla has compared to other competitors. Jessica, what will this mean for competition? Could it spur competition?
I mean, it's definitely going to spur competition. I mean, if you're out there, you're shopping for a vehicle, one is eligible for a $7,500 rebate, one is not. I mean, you're going to shop both vehicles. Of course, everyone knows what Tesla is. They have a lot of brand recognition, but something like this is going to get shoppers to look and consider other things. And a lot of times that does ultimately end in a purchase. So without a doubt, Tesla will be at a disadvantage if this goes through.
Jessica, just set the context here, though. $7,500. What does that mean for the ultimate price point of an EV right now? Because, well, they're not cheap. And $7,500 doesn't seem that much in comparison to the cost of a Rivian, for example.
Yeah, I mean, that is true. But I think as we go towards the mass market consumer, they're looking for cheaper EVs. And in that case, the $7,500 does become probably more attractive because someone that's buying a $100,000 EV, they're probably not bothered by these rebates anyhow. And at the end of the day, people are buying a lot of times, even though they shouldn't be, on monthly payment. And so when it's calculated out, you're looking at the monthly payment, the $7,500 apply, especially for lease customers, that can make a really big difference and make that a lot more attractive and get consumers to buy.
California, though, I'm assuming, has been a first adopter, early adopter of EVs more broadly when you compare state to state. So how much of the mass market is still left to penetrate in California?
Well, I think that's the whole thing, is that in California, the EV market share over 20%. So you have a lot of mass, or a lot of early adopters have already purchased. So getting the mass market is probably the bigger challenge here, because these people need convincing. They probably don't have highest income. They're kind of questioning whether they even want an EV. So if now is a time, if there was ever a time to have an incentive on EVs, it is for the mass market, not for the people that were early adopters that were excited about EVs to start with and probably didn't need much incentive to even purchase.
Just compare state to state. We know that Newsom has not been afraid to push back at Elon Musk and indeed perhaps be a key supporter of the EV sector. Would this be replicated elsewhere, do you think, if federal support did come away?
I mean, it's likely. We have things like CARB states. Other people are following some of the California Air Resource Board, some of the edicts that they have put out. So there is a precedent here of other states kind of following California's lead. But at the end of the day, this program does sound quite costly, especially if you're to sell a lot of vehicles. So states going to have to find funding for this program, which may be complicated. I mean, California has a clear order, zero emissions vehicle by 2035. And, if that's the case, then programs like this will have to exist to spur that mass market to start to buy.
If they really wanted to spur the mass market, you'd anticipate that you let Chinese EVs in, which are much cheaper than US competitors. Who, therefore, given that that won't be the case, where are the cheaper vehicles? Who will this end up supporting?
Well, I mean, I think any automakers, I mean, they're all kind of scrambling. I mean, in this era of affordability, cost of living increases, inflation, people just feeling a lot less wealthy than they have in the past has been a big issue for car buyers. So I think a lot of automakers are trying to focus on the lower end. So anyone that is delivering good value that kind of has maybe like a $40,000 price tag, they're probably going to get a lot more eyeballs than some of these other things that we have seen, like the Jaguar coming out in a few years, or any of these, six-figure EV type of vehicles.
All eyes on the Nissans of this world. Jessica Caldwell, we thank you, Head of Insights over at Edmunds. Meanwhile, coming up, Klarna, getting ready for that IPO. We'll discuss with headlines, Cameron Ansari, and what it means for other fintech companies that may also be mulling going public. This is Bloomberg Technology. A group of former Google and Stripe executives who helped build the Android platform are now raising $56 million for a new company. This one focused on developing an operating system for AI agents. Bloomberg Shireen Ghaffari joins us now. Shireen, every other moment I seem to be reading about the latest AI agent company, and this one's actually to foster an operating system for its adoption.
That's right. So the idea is they're not actually building the agents themselves, but because they believe that the future of computing will not be necessarily about apps, but the next evolution of these AI agents, that they want to build something that will connect all these agents to be able to talk to each other and for developers to all build on one platform, kind of like how we have Android for OS.
It's called, well, I don't know how I would say it, /dev/agents or just dev agents. As they're coming out of stealth, this is the new name. They've got some really interesting characters on their cap table now. So Alexander Wang of Scale AI. They've also got Nikesh Arora, who we've been speaking to on the show recently, of Palo Alto Networks. But who are the VCs behind this, and how do they find them?
That's right. So Index is leading the round, and Alphabet's independent growth arm, Capital G, is co-leading it. And what's interesting is that, these guys have been known for a long time in Silicon Valley, helping build the Android platform. And, the CEO is also a former Stripe executive. He was CTO there. So, these people, these investors have known these leaders for a while. And actually, the lead partner at Index knew the founder back at Google. They both worked together briefly at Google. So it's a really interesting, I think, case study of where you see this sort of founder market fit, the lead investor told me, right, where people have a lot of confidence in this group to be able to execute on this kind of ambitious plan to build a new network that can connect this future wave of technology we're seeing with AI agents.
David Singleton, who was over at Stripe as CTO, calling it, we need an Android-like moment for AI. Shireen Ghaffari, thank you so much for bringing us the latest funding round. Meanwhile, let's dig into funding rounds to future IPOs and exits. Klarna, for example, another key fintech that we're all getting on our mind for its IPO. We understand it almost broke even in the first 9 months of the year, company stating that as it eyes the markets. In today's VC Spotlight, let's dig in with Cameron Ansari, his partner at Headline, who understands buy now, pay later deeply. And I'm interested in Klarna. How important, how integral to the market opening will its IPO be?
Well, it's going to be huge because we really haven't had a major tech IPO in months. We had Reddit and Ibotta came out back in the spring, but it's been quiet since then. I think everyone's been waiting for the election outcome and also to see what's happening with interest rates. But now that we're past that, I think Klarna is going to be the first real test of the market.
And in terms of valuation, like they've been on a volatile ride.
Roller coaster.
And so too has Stripe. Look, both of these companies were caught up in the 2021 euphoria around fintech, and both had a sharp realization of what valuations really are. Klarna's been bringing its way back, as has Stripe.
Absolutely. Look, I think Klarna did a very smart thing. They got over what I call valuation nostalgia, where you feel like I was worth X before, I should be worth X now. It's not true, right? The market's adjusted. Everyone's kind of worth a different price than they were in 2020 in a zero interest rate environment. So Klarna was valued at $46 billion, and they came down and did a round the next year at $7 billion. That's a tough pill to swallow, but they did it. They did the reset. It was a sober, great decision, and now they've built their way back up. And this IPO, by all indications, will price probably somewhere in $15-20 billion sort of range, maybe a little higher. Their main comp firm in the U.S., the stock is up like 500% in the last couple of years. So I think they're coming out at a great time, and they're going to get to, hopefully approach back to where they were. But they did that reset, and it was very smart of them.
What's interesting is that the secondary market has been so active and so many companies have a decent chunk of change, they don't need to exit. So, for example, Stripe has been buying back its own stock from previous employees. They so little need to go and tap the markets. Why then should a Klarna or a Stripe eventually come an IPO?
Look, an IPO really does three things. It's a marketing event. It's an opportunity to come out and say, here's what we do, here's what we are. My parents may have not heard of Klarna before, but now they will. Klarna is telling a big AI story. Then I call themselves the AI-powered global payments network. So that's the first thing. The second is it is liquidity, right? It does provide liquidity in a deeper way than any private funding round can to employees, to investors. And the third thing that's really important is it sets a really clear public equity price for your stock. So you can use that to then compensate employees, to hire, and to do M&A, to buy companies. Because before that, it's always this parlor game of, well, what's the stock really worth? We don't really know. And now you'll know every second of every day how much it's worth.
What are you thinking about M&A? Because I believe that you backed sort of a Klarna similar that got bought by a bigger tech company. Are we going to see more M&A in the space?
I really think so. I backed a company called Bread Finance, which was bought by Alliance Data Systems. The whole company is now called Bread. It's a very similar company to Affirm and Klarna. And in fact, in the fintech space and tech overall, we've seen very little M&A. Part of it's been the regime and the regulatory process where people are afraid that deals will get blocked. I think by all indications in 2025 with the new Trump era, we'll see a more friendly environment for M&A. And I think folks are kind of leaning into that now. And you saw some rumored stuff. There was like a Qualcomm deal that was going to happen. We've heard about HubSpot Google, Wiz Google. Those didn't turn out to actually happen. But I think in the new year, you will see M&A pick up as well, absolutely.
How do you prep your own portfolio companies then for that new era of 2025?
I think, the thing has always been, cash is oxygen and oxygen is life. So you have to have enough cash on hand to make it through whatever period of time. And these last couple of years have been tricky in that regard. So companies have been raising, debt rounds, bank equity, loans from banks, convertible notes, things like that, to bridge and get through to a period where hopefully there's going to be more liquidity and better environment for exits.
What about you and your thoughts on building up holdings in companies via the secondary market or going direct to when they're doing fresh sales? What's the environment been like? How hard, how pure is it at the moment? Or is it kind of, it's who you know in the back door and therefore you get access?
It used to be that way. 10, 15 years ago, secondaries was always kind of whispered and so forth. And there's famously a massive secondary market for Facebook stock, before it was public for many years. But a lot of companies put limits on secondary sales, and you can only sell a certain portion, or some companies don't allow sales at all. They have rights of first refusal to stop sales or purchase the stocks themselves. But now you have all these other markets like Forge and Hive, and while Carta was trying to do this, where you have a kind of more liquid, quote unquote, secondary market where you can see the most up-to-date pricing. But it's still very episodic, where some deal happens and then maybe 6 months goes by. So you're not really sure exactly what the pricing is of these shares in any given moment in time.
And how difficult is it to understand some of the nuances in the deals? Like, contracts are very individual, and some of these very hot companies are able to have pretty tough rules on how you speak about them and how you invest in rivals. What's that looking like?
Well, the biggest thing is information, right? And information rights are very limited for investors who come into, say, a secondary in a company like a Klarna or whatever before they're public. You don't get all the rights. You don't get all the financials. You don't get all the documents. You're just told, okay, look, this is the information you get. This is the price of the stock, and that's it. You have to kind of live with that. Once a company's public, then obviously you get all the full information, and it's a level playing field for everybody. And it's a much, I think, more rich environment for folks to be able to invest with full info.
We'll see how that full info comes to bear next year. Cameron Ansari, it's so great to have you, partner at Headline. Eon, it's a cloud backup startup. And in fact, it was founded in just January of this year by a group of Amazon Web Services alumni. And it's just closed a new funding round valuing the company at $1.4 billion. That's less than a year after founding. So we're going to talk about it with Ophir Ehrlich. He's the CEO, joining us now. You've done 3 funding rounds in 1 year of your first existence. How are we doing this? Talk to us about what problem you're solving.
Actually 4 rounds of funding. First round was led by Sequoia, second round Lightspeed, then Greenox, and lastly Bond. And what we're doing, we're making cloud backup useful, because now they're not. And if you think, why should we care about cloud backups? I mean, my grandmother have backup on her iPhone for all of her kids, over on the grandkids. So it's not that easy in the cloud. You see, on-premise, everybody have everything. And in the cloud, companies just moved in the last few years. They're spending hundreds of billions of dollars annually on the cloud, out of which 20% is cloud spend, is backup spend. And this is a huge spend. And today, it doesn't work. It's very cumbersome. It's a mess. And it's not useful. You can't even use it when you need it. So it's a very big problem, and we're happy to solve that.
I mean, AWS saw it as a problem, and they bought your previous company, Cloud Endure. So how long have you been fixing this problem? How are the ways that the technology is changing to ensure that it is less cumbersome going forward?
So we've seen it. We had a front row seat when we were in a previous company, Cloud Endure, and then after being acquired by AWS. In AWS, we built the disaster recovery service for enterprises. So we had a front row seat seeing very large companies either moving to the cloud and starting using that for resilience. And apparently they encountered many problems related to how you manage your data, how you govern that, and then how you make sure that it's safe and that you can access it when you need it. So we've seen it I'm doing this for the last 11 years, and my partner's doing it for even more time than that. And when we left AWS, it was very vivid that the time is now, because when enterprises move to the cloud, they form these new organizations, cloud infrastructure, or cloud operations. These are organizations responsible for all cloud resilience across the organization. 20% of cloud spend, which is tens of billions of dollars annually, but simply it doesn't work. The same technology and the same architecture which worked on premise, it simply doesn't work in the cloud. It's like trying to take a square peg and fit it into a round hole. And we are here to fix it in two ways. One, we want to make sure we are able to manage all the data for the entire organization, help classify everything, understand what's important to backup, what's not, to which retention policy. And then we're making it very easy to actually access it when you need it. For example, compliance audits, both internal and external compliance audits.
Okay.
Let's say that you're an insurance company and you want to access your data from 3 years back. Who knows if you have backup? And if you do, how long will it take you to get the data? Today, it could take days or even weeks. Right. Companies are missing compliance audits. It's very bad.
So you're this fix for it sounds like you've built the offering. So when you're going for your fourth round of funding, why do you need the funds? What is it you're going to be spending it on?
So we found out that as this category emerges and there are very big problems that customers are having, we want to make sure that we have everything we need in order to support it and solve it quickly in an enterprise level. Because the budget are huge, the pain is enormous. And frankly, today, what's going on is a mess. And we need enough funding to make sure that we're building a comprehensive solution fit for the enterprise so that we are well positioned to solve that for every company, big or small.
Engineers, marketing, sales, I'm sure you'll be bringing on a fair few. E.ON CEO, Ophir Ehrlich, thank you for your time over in Israel today. Meanwhile, that does it for this edition of Bloomberg Technology. Don't forget to check out the podcast. You can find it on the terminal, as well as online on Apple, on Spotify, on iHeart. From New York, this is Bloomberg Technology.